One of the great things about doing money talks over so many years, you get to meet and get a chance to chat with some really deep thinkers about the markets, about the economy, about things that we care about. And that's why I've been excited for a few weeks here when we booked Tony Greer with me. You know him at TG Macro on Twitter, at TG Macro. You can find him, of course. He's the editor of The Morning Navigator. Still, how he does that is beyond me because literally it's every morning. I also enjoy him on Substack, tgmacro.substack.com. Tony, appreciate you finding time. Obviously a busy time, but it's always a busy time when you're a trader.
Like, I always have time for people like you, though. This is the most important time that I spend during the day is, giving back and having conversations with people that have given me a platform and a place to speak to an audience. And you guys are top priority for me, man.
Well, we appreciate that. And let me start with this, is that Tony was the guy who came along with this phrase called the Great Rotation. It was from tech to commodities, but he didn't wait. He did it. The timing was perfect. I remember we had done a conference on the coming commodity bull market, and I reach out, and there's Tony. Tony's saying, hey, guys, let's get out of tech and let's get into commodities. Now, here's something, a wonderful call, but I think you topped it. Because when you came into March of this year, you said, no, I don't like tech, but I'm buying them. The markets and your methodology and your process had taken you to that point. And I was just, as I say, I thought that was incredibly impressive. Can you share with me the kinds of things you looked at? Because that's a pretty big about face to saying, I don't like these companies. I shorted and made some money. Now I'm going to go long in March of this year, which is pretty damn good timing.
Yeah. Well, Mike, I'm out of that trade and on to the next one already, but let's go into it for a moment, right? Like that trade is purely a product of my process, which I've become really proud of. Is something that, kind of was in its nascent stages when I was working for other banks, or just call it other employers, and, kind of more casually trading on the side, not spending enough time trading on the side. Then when I started my own business and I had more time to really, really dig into, my own trading book and my process of following the markets, I came out with basically a spreadsheet that helps me follow markets, Mike. And as a market junkie, I get excited to look at the closes every single day, every week, every month, and look at the performance of securities across those periods of time. So every Friday at 4:00, I sit here and, take down the weekly performance. And every month end, I take down that performance. I study it. I see what was moving the most. I see what moves were the most technically relevant. And, I try to decide how to guide my clients into the right sectors for the right periods of time. And, when we were in a period, just to speak to that trade a little bit, we did manage to be on the right side of the outflows from technology and into natural resources last year, but that was last year's trade, So this year we had to pivot into technology, and we sold that trade on the Nvidia breakout. Basically when Nvidia came out with the news, that was a big out, and we sold the tech that we had into that rally and kind of sat here looking for the next trade. But that was from the place of technology was beaten up. There was a humongous rate reversal in the markets, right? That was the time.
Yeah.
That was when Jerome Powell had a meeting on the FOMC, I think on Wednesday, and said that the terminal rate on rate hikes was going to be higher than the market anticipated. 2-year notes traded 5% that day. The next morning we came in was the Silicon Valley Bank blow up. And by Monday, 2-year yields traded 4%. So that was an unbelievable new high and reversal that happened at light speed. That was the fastest rate move I've ever seen potentially. And the one way to think about it was, okay, at this point, let's look at the equity board, right? The most beaten up stocks are tech stocks. If we've got a rate reversal that's going to start trending lower, higher rates is what's been killing these growth businesses. So maybe we can be quick enough and get into technology before the big behemoths figure out what's going on. And that's essentially what happened. It was just kind of the gut reaction to that. And, it took a couple of days to come up with the idea to buy tech. It wasn't like that weekend that we decided to. But when it started to show that it performed out of there, started to make some attack on some technical resistance levels, for me, that's like an instant green light go. So we got into tech. We rode it for about 5 months or so. And it was a great trade. It was a great trade, right? We got a good in, a good out, quick in, a good out in the Nvidia news that gave us a real gap higher on the position we had on, and we traded them. And that's kind of always the way that we'll do it, and then I'm doing it here at TG Macro, and and then from there we kind of sat tight for a little while, and we kind of pivoted back into energy, right? Because I think that there's a chance right now that we see a short period where the great rotation can come back again, and we see a little bit of pullback in tech and a little bit of rally in commodities. But I don't want to go too far past the conversation.
But there's so many things within that. One, I just want to highlight process just for a second. You cannot perform in anything in a business or what have you, but in the markets without a process. And your process is born of 30 years of direct experience, direct trading experience, and analytical experience, of course, in the last several years, nearly a decade. But I'm just pointing that out. If people try and approach these markets without a process, they're dead. So that's one thing. But the other was interesting about the sort of time frames we're dealing with now seems to have shortened. Like it's difficult for you to say, or anyone, but you've done it accurately, to say, hey, this is a trade you're going to sit in for a while. No, you don't. Of course, you don't know that. But as I say, have you noticed the time frames just shifting on this and shortening at least? As you say, got in and here we are just 5 months later. I don't think so.
Yeah. Well, Mike, this I think is very much, we've been calling this market a totally chaotic, nonlinear market, right? And I think that that's a function of the 2s10s curve, for example, the yield curve being buried at like minus 100 basis points, right? We're at historic low levels in the curve here. And I feel like what that means is you're going to wake up every morning, and some mornings there's going to be a snowball that goes through the window that ruins all your plans that day.
Yeah.
Right. And all your trading plans where, you think you're trading the oil follow through and oil gets crushed that day. And you think gold is breaking out and gold gets crushed the next day. And you think you're buying something on the dip and it keeps going. Right. Like there have just been this market has been especially tricky. Like you said, we're seeing viable moves within sectors to participate in that are like, intra-year trades. Right. Yeah. There are trades that are lasting only, 4 weeks, 8 weeks, maybe a quarter. And then already it looks like this is the next sector that can go now. So with me, that's the way I look at the world. And yeah, this has been a crazy, crazy, hectic year that's been not like many other years that I've ever seen before.
And when you're saying sort of nonlinear, just to clarify, I mean, I would assume you're thinking, these old relationships don't work, or things you say, well, that would make sense, and like you jack up interest rates, well, X, Y, and Z should happen, and then it doesn't happen.
Exactly. Exactly. So we just saw rates go higher, and you could have expected the builders to get crushed, and the builders didn't get crushed. They kept performing. So we got into those because they showed signs of strength. And next thing you know, they rallied and we got out of them again. But I'm saying like that was a trade that we rode higher in the builders while rates were rising, right? Yeah. Like counterintuitive.
Do you use an overview, a big picture overview, and then drill down? Or is it strictly driven by what you're seeing in all your indicators? I mean, and to heck with what you think, to heck with your opinion. It's the indicators that are going to drive the bus.
Yeah, that's the way to look at it, Mike. I used to trade with the idea that I would sort of consume as much information as I could consume. And I would decide what was, too cheap or too expensive. And I'd put my positions on and I'd wait for the world to come to my view.
Yeah.
And that was such a ridiculous approach to making money now that I look back on it. But it was really the way that I learned, I suppose. And then I just started realizing if, you follow the tracks on the market, sometimes the market tells you which way it's going to go, and so it became very much, I don't have an opinion. I let the market tell me which to be in, and then just kind of putting that together with, I guess a technical overlay of, knowing where there's going to be some acceleration, knowing when things are consolidating, knowing when things can explode, when they're susceptible to breakdown. All of that stuff goes together into, putting you and your clients in the right trades for the right periods of time.
It's interesting when I listen to you, and forgive me, this isn't your words, these are mine, but I listen to the professionalism there and I think, is that the antithesis of how they make decisions politically?
Right.
I mean, they don't have a methodology. They don't have a process. They don't have an exit point. I mean, the list just goes on. And I'm just, as I say, listening to you going, that's how a professional does it. and we don't have professionals making these major decisions. So,
No, that's
yeah.
exactly right, Mike.
So,
That's why I stick to the markets, believe me.
yeah. Let's talk about oil for a second, because I know you've been posting just recently, and again at TG Macro, you've been posting and you've been in the Morning Navigator that, hey, that oil trade's getting real interesting. You know that. So I want you to elaborate on the oil, and of course, I just want to let people know about the podcast, Oil Ground Up with Tony. Which gives can elaborate on his views on that marketplace. But okay, what grabbed your attention first?
Yeah, Mike, thanks very much for highlighting the podcast. Super kind of you. I'm enjoying that. And so to get right to the oil story, the narrative, I think, has been during this long period that oil consolidated between like 67 and 75. There was a
Right.
real clear SPR sale from the Biden administration as the seller, and the OPEC tightening, courtesy of Mohammed bin Salman and the rest of Saudi Arabia and the crew, kind of on the supporting the oil side, right? So there was a strong back and forth there. Output cuts, so OPEC cuts output, SPR comes out with more sales, right? And there was a real back and forth there. There was as much as, an actual Biden and MBS meeting in Riyadh, right? That happened last year. And so that all of this happened and oil consolidated for months and months and months. And so that's when I start salivating, because I know that eventually it's going to break out and we're going to be able to make some money. And I don't even know which direction yet. But as it turns out, we basically stop announcing that we're going to sell the SPR. So we finished selling our strategic petroleum reserve for now, it looks like. The Biden administration tries to look smart and say, we're actually a buyer now on the dip now that oil is going lower. OPEC comes out and says, oh, that's really interesting. We're cutting output. And by the way, this time they came out and said, we're cutting output, and the market should be aware that we may be doing more cuts more often, more cuts, maybe bigger cuts more often going forward. Right. So this is sort of in the wake of them realizing that it's becoming a little bit more politically unpalatable for Biden to sell any more of the SPR. I mean, taking it to zero would certainly raise an eyebrow. So now we've got OPEC coming out saying they're going to keep the market tight. That going along with the fact that all of the recession bros, that I like to call them, that are out there in finance trading these markets, they all got a little bit disappointed when we got our last GDP number. Right? We got an upside surprise in GDP. Everybody's got to put their recession forecast on hold for now. Oil and gas demand has been extremely steady. Then in the last several weeks, we see a situation where the gasoline spreads tighten up and get extremely backwardated. Right? A lot of that has to do with some of the gas coming off the markets. It has to do with all kinds of it has to do with sanctions, and there's a lot of moving parts to it. So what happens is the gasoline market tightens up, the crack spreads tighten up simultaneously, and when that happens, price generally rises in oil. So we just saw the whole complex rally. We saw it rally to the top of the range that it's been in, and it feels like it's about to break out. I had the top of the range at around 83, so we've broken out a little bit beyond that, and it looks like we've traded back down to that level. But if we maintain this story where the gasoline spreads remain tight, diesel has been not really the story this year like it was last year, but diesel is tightening up alongside it. And if you have gasoline and diesel tightening up on the exchange, we've got great evidence of, continually strong gasoline demand. That to me paints the picture for a potential upside breakout. And when I think it breaks out after consolidating for so long, I'm going to expect it to rally for a long time. So I think that's about where we're at the cusp of right now. And I think that in addition, not to go on too long of a rant, I feel like there's tension between OPEC and Biden, or at least between Saudi Arabia and Biden, to the point where I think they'd be happy to try to rally the price of gasoline to make his reelection a little bit more difficult. So we'll see what happens. We'll see what happens, Mike. That's how I'm playing it right now.
But it's interesting to hear the sort of parts of the fundamentals that you're seeing as a backdrop to it, but then getting the confirmation within the markets itself. I mean, one of the puzzles I've had is it seemed like the physical demand was there. The physical demand was there for oil, not getting necessarily reflected in that drop in prices below 70, for example. I was asking, well, where are some of the fundamentals to support that drop? You know, I'm not seeing it, you know, as you just alluded to. In fact, we've seen the opposite. I mean, I'm on that long-term view of having lived in India, for example. Are they kidding me? Do you think they don't want energy? You know, the most populous country in the world. You know, I
Yeah.
know China's been a disappointment in demand, but long term, it's demand is there. You know, period. And
Mhm.
all the emerging markets. You know, all the emerging markets. I mean, energy is raising your standard of living. So I see that as a major backdrop. But I never saw anything that supported the drop. You know, I know China was a disappointment, but it just seemed like the commodity markets wasn't particularly attached to the fundamentals in the physical market.
Yeah, no, it's been a tough read, Mike. It really has.
Yeah.
There's a while where we still had, gasoline inventories and diesel inventories on their lows, and the spreads leveled off and the price backed off. It was like, really kind of some surprising stuff going on. But, you know, I think now the gas market is in really good shape, right?
Yeah.
With cracks rallying, spreads rallying, you've got refined, my trade is to be in the stocks. Oil is one of the commodities that I do actually trade, but most of the time I'm looking at the macro world and trying to trade, the right sectors in the equity market.
Yes.
We've gotten our clients into oil and into oil stocks recently. The best performers that I've seen, names like Marathon Petroleum, which happens to be a name that I went with at your
Yes.
conference.
At the World Outlook. Yes. In
Yeah.
February.
And you guys were like, what are you going to be in for the next year? And I said, I'm going to stay with a refiner. And so Marathon is sailing along this
Yeah.
year, which is really making my call look good. And then you've got oil services picking up right behind it and E&P kind of right behind that. But I think that what's most important to me is that this year, all we've seen, and especially most recently, heavy equity inflows into tech, heavy equity outflows out of energy because they're expecting the recession.
Mm-hmm.
Right. So if we have a situation now where rates can go higher, if CPI is like in line or a little bit worse and the bond market continues to kind of tail off, rates continue to kind of peak higher, to me, that's another sign that we could see those growth stocks, i.e., technology, back off with higher yields and the commodity markets go on a run again. Higher yields kind of confirm for the portfolio managers that we are in an inflationary period that people are going to latch on to hard assets in. And then that trade kind of materializes before your eyes. So we'll see what happens. It's been weird. It's been only an oil commodity rally so far, if you've noticed,
Yeah.
right? Gold backed off, call it $100 from, almost 2K to 1915 now. Base metals have been nowhere. Copper's breaking down again, technically below moving averages. The grains market has been a random number generator to me. I can barely understand what's going on in grains, and I haven't traded them in months because they're not trending. Years because they're not trending. So I'm really oil centric right now, Mike. Right, I'm a bull market trader, and I'm most comfortable swimming in the energy and oil world. So that's really where I've got all my chips right now.
Uh, Let me ask about another, though, that's sort of not, again, the confirmations we look for. Um, so gold is backed off for sure, but it has not a bad, and I'm not talking as a trader. If you just look at the trend, it's done well. Who hasn't done well? Gold stocks.
Yeah.
Like they did not follow that trend. Now, I sit back and go, I didn't buy any because of that, but I sort of go, I want to. Isn't that funny? You sit there and you go, I actually want to buy these, but they're not allowing me to because I'm not seeing the action you'd need. It's just funny, but yeah, they have not kept pace.
No, they've been terrible. You can chart them versus gold, right? And chart
Yeah,
GDX versus the gold, the commodity, and it just continues to slump. And
yeah,
I think that's what you see now. I mean, I'm literally kind of on my back with a gold miners position, or I'm not really on my back, but about to stop out of it off about 5%. My stop is right at 29 here, and it hasn't triggered yet, but I'm guessing that it's going to. It's one of those sectors that's just kind of underperforming and not wanted, right?
yeah,
There's nobody out there talking about it. There's no excitement. Are you going to put your money in AI right now, Mike, or in gold stocks if you want to
yeah,
make money in the short term, right?
yeah.
Gold stocks, you have no prognosis. At least AI, you're rolling the dice a little bit and you're in the game. So I feel like that's what a lot of portfolio managers are clinging to at the moment.
Let me jump to the base metals for a second. Again, I've got that longer term perspective, but what are you seeing in the base metals?
Base metals have kind of been, for a trader, Mike, it's been a no-fly zone.
Yeah.
for me, right? I've gone with a couple of upside breakouts in copper and I've been disappointed. I'm still of the mindset that if we are going to continue with this aggressive push to carbon neutral and electric battery power, the copper and aluminum and cobalt and lithium, and it's got to come from somewhere, right? And we're generally at historically low inventories right now across the base metals complex, definitely in copper and aluminum. And so I keep wondering, if we're going to have this big push towards electric battery power, where are they going to get the metal from, and when is the price going to respond? So I kind of hold a fundamental long-term view of it. But until I see sectors like XME, industrial metals and
Mm.
mining trending and, really competing with some of the other leaders on the board on the year, it doesn't get excited for me as a trade to be in, so that's just how I'm looking at them. And, I probably tried Freeport once or twice from the long side this year, only to make no money trading it. And so if they're not going to trend, then I'm not going to participate. That's kind of how I look at it.
But I think that is a wonderful example of, as you say, you haven't had the triggers to get you into a trade that you might quite like,
Yeah.
but it's really difficult for people to get over their own opinions, to not care about their opinions, and as I try and explain that, I say, well, my God, if my opinions mattered, then everything I'd ever bought would have gone up. I mean, clearly I made it played short, but clearly that's my
Yeah.
opinion.
Yeah.
And believe me, that hasn't been the reality. But I can't tell you, Tony, having the pleasure and opportunity to deal, as you said, out the World Outlook Conference. Great. We see a quick 1,200 people. And it's fantastic to chat with them. And I do in other areas too. And my point just being that has to be, and there's lots about discipline that's difficult for people to get, need the tools to overcome your emotions, is how I'd put it. But this is the one, somehow we've fallen in love with our opinions. And the reality doesn't match those opinions. We don't care. Well, what a formula for losing money. And you've just described it beautifully, how a professional does it. Yeah, you've got the opinion and you're waiting for the signals to act on that opinion.
That's right. And, my hands are tied until the market shows me that, that these stocks are doing exciting bull market type things. Right.
Yeah.
And if I don't see them, I'm not going to get involved. And I like the way you tied it together you said something that's one of my most firm beliefs in trading is that you have to trade with no emotion.
Yeah.
And you can only trade with no emotion if you have a procedure, right? And if you have a procedure and a process that's kind of getting you into and out of things, then, you're kind of just there driving the car, and it doesn't have to be as, viscerally stressful if you know how to manage risk. And when you lose on trades, you get out. And I love nothing more than taking small losses. And so I'll nick myself 100 times, but usually when you hit the payroll, you pay for all those little losses. And that's the only way to make money trading.
One of my favorite quotes, which encompasses what you've just said, is Bernard Baruch saying, if you don't know who you are, the markets are an expensive place to find out. So
it's really good. Yeah.
Yeah, because I certainly didn't have the emotional makeup to show that discipline on a very short term. And I think your point is absolutely has to be heeded, which is, think about that, everyone. He loves to take small losses, and I always think I've watched this miraculous magician's trick. There's nothing like a short-term loss to turn that into a long-term hold. That's what I see people, but I've seen so many people do that. What were you holding that for? Oh, about a month. It's a spec, the Vancouver Stock Exchange.
Yeah.
Wasn't that 8 years ago? Because they don't have the emotional makeup to take even a small loss, let alone, and when that's what turns into big losses. Someone who can't take small, now you found out how to get a big loss.
Yeah, that ties into really well, like one of the things people often ask me, like, what's your trading time frame? And my ideal time frame is like 2 days to 2 weeks. That's generally the moves that I like to hunt. But the only way that I stay in trades longer than that is when the trade keeps me in it.
Yes.
Right. Like I operate with a trailing stop loss. So if I buy something and I have a trailing stop loss, I may have a 2 week or 2 day to 2 week time frame. Some positions I've been in for a year and a half with the same idea because they've never taken me out. And you just, like Marathon Petroleum last year happened like that. We got in and we set our stop, and our stop never got triggered for the entire year. Stock was up 80% by the time it was over. So that's the only way that I've learned to stay with a winner. is when the market
Yeah.
lets me stay in it, and I keep moving my stop loss every day that it goes up, and it never catches you. So that's
Yeah.
a good. That's one of the good stories that happens. Sometimes in the markets when you get them right.
Well, the problem with the market is it's such a clear scorecard.
Yeah,
I say about whatever analysts or analysis I put out, what I say, well, I appreciate you disagree. We'll find out. I mean, that's
last
another
sell rule,
difficult
right?
one. Yeah.
Yep,
We're there
exactly.
to make money. We're there to do these things. And but that's why the business, I mean, sorry, it's just so fascinating, so engaging. You can find so much out about yourself, about how the world works, how other people, et cetera. Uh, Let's just finish with this. And I know it's the broad thing. And here I'm talking about technical analysis, and then I ask you the big fundamental. But
That's all right.
broadly speaking, do you stay optimistic, or do you care if it's optimistic? When you look at the market, you look at the things that are happening, because this is part of that disconnect that we're facing right now. Hey, interest rates are up. The market shouldn't be up.
Mm.
That I know that's simplistic, but that kind of thing. So do you have an overall view of the stock market? Any indicators giving you anything here?
Well, yeah, you put it this way. I wake up bullish, right? As a general premise, I really
Yep.
do. That's kind of how I approach trading and approach my job and things like that. No matter what's going on with the S&P, I'm always trying to hunt the things that trade from the bottom left of my screen to the top
Yes.
right hand of my screen, across different kinds of time frames. So those are the things that I can get in and participate in without hurting myself. So what I think about the stock market now is, I do think it's going to be volatile, but what I'm okay with is that the economy seems to be doing a little bit better than people expected.
Sure.
And if rates are going to rise and the economy is going to continue to hang in there better than people expected, that's a pretty good recipe for a bull market. Like I've seen that recipe before where rates are rising slowly, and the economy is actually kind of hanging in there so they can bear the higher rates and the stock market's okay with that. So I feel like, we're still working on a bit of a technical breakout. So then behind that, you've got the fact that it's a little bit, a little bit. So there are times when people get bullish, but mostly speaking, everybody is waiting for the big bomb to drop
Yeah.
and the big recession to hit. And that's going to, when the big recession may hit, that's fine and interesting. I don't know what that has to do with the stock market, right? Because one is an economic condition and the other one is a market of securities. So I don't think that they necessarily have to mean that a recession is bad for stock market. So if we're going to have this religion that we're getting into now with AI, where investors are not very concerned about valuations and they're happy to continue to go after, next year's earnings and next year's story, et cetera, that can go on a lot longer than the bears can stay solvent. And if we then run into a situation like we're running into now with oil, where, a tight market leads to higher energy prices, leads to an inflationary scenario, leads to commodities can rally, I have a tough time figuring out why the stock market should collapse. Right
Yeah.
now, I'll trade dips and I'll expect things to back off and things like that. But generally speaking, I think the direction that the S&P is headed is north.
And again, as you say, you're focusing on the oil sector. That's the one you're comfortable with at this point.
Right. Yeah.
And of course, people can just keep up with you by just subscribing to the Morning Navigator, because the markets change and you are forced to write about it on a daily basis.
Yeah.
But also, speaking of oil, and let me remind people again that you do the Oil Ground Up podcast, or of course on Substack, tgmacro.substack.com, or something I check every day is at TG Macro on Twitter. So lots of opportunity. The market's changed. Tony will let you know what he thinks about it. And Tony, in the meantime, know how much we appreciate you finding time for our audience. Sincerely, thank you.
Mike, you're a sweetheart. I absolutely loved coming to the conference. I saw what the Mike Campbell magic was all about when I was there, and I'm honored to be on your team, man. Anytime you want to hear from me about markets, you have my time.
Well, that's wonderful. Thanks, Tony.
You're very welcome, sir. Thank you.